Hey everybody, welcome. I'm gonna give you guys a few moments and to get on here like I usually do. But let me just let Instagram know we're on. I am officially going live on Instagram, and usually there's another group I let know that I'm here, but I'll do all that while we're talking. But anyway, let me do my formal introduction. Hi, everybody. Welcome. This is Tamaya Robles. I am your credit repair expert specialist. I'm the owner of Fix My Credit Now 850.com. I am the host of my podcast, Coast to Coast Credit. And you guys are officially here with us live for our weekly segment, Ask a Mortgage Loan Officer with Sean Rogers, who is here with us. Now, just a reminder, people, I am just the host. This is all about Sean. Feel free to ask questions. Leave them in the comments, but keep in mind we are not on the platform that you're watching us from. So if you're on YouTube, Instagram, Facebook, and you're trying to leave a comment and show your name, it's not going to show unless you join StreamYard. Other than that, you can still comment. We'll see it, but we just won't see your name. But anyway, I'm gonna give this all to you, Sean.
Awesome. Thank you. Thanks for the warm welcome. So today, what I want to go over is how we view credit on the lender side. I'm going to talk about some frequent offenders that I see, not people, but as far as credit issues that I run across a lot, and how could adversely affect your qualification. So what I've done, I've redacted one of my customers' credit reports, so we can't see the personal data, but it gives a good example of things that went sideways in someone's life. And I'm going to explain and break down how it's going to translate to your qualification and your approval. Okay. Now, first things first. Okay. Remember, everybody knows, well, if you've been, looking at buying a house or researching, mortgages and whatnot, you see lenders advertising certain credit scores for certain programs. They say, oh, to qualify to buy a house, I need a 620 or a 600 or a 640 or a 580 or a 500, whatever the case may be, right? What they don't tell you is that not only the score is important, it is also the credit profile. So what's on the credit or what makes up the credit. So we look for certain things that are on the credit that could adversely affect your approval. So what I'll do now, let me see if I can share my screen. I'm going to present here. Give me just a second. Let's see, here we go. Okay, I don't think it's working for me. Can you see my screen, T?
No, I can't.
Okay, hold on. Let's see if I can do this a different way.
Do you want to give it to me?
If possible, yeah. Let me just, I don't know how, I can't even exit out of here.
You should be able to definitely share. You said exit out.
Yeah, like close out I can't, it's the settings, it's the settings on my browser that's making it where I can't see the bottom to hit OK. That's the problem, and I can't zoom out. So let's try this. Here we go. I think I may have fixed it. I'm sorry, give me just a second here. Yeah, it's not. See if I can.
And thank you guys for your patience. Sean, while you try to fix that, I'm just going to say a few things because there's people coming in. So, everybody, just thank you for your patience. I appreciate that. We both appreciate that. Little technical difficulties, but I'm actually excited that Sean is deciding to choose this topic. Um, Sean, you might want to press mute because we can hear
Okay.
that. Okay. I'm excited that he's sharing this topic with us because, as a credit expert, I come across a lot of clients, potential clients that come to me and they're like, well, I should be good, right? Or the last time I checked my credit report, everything was straight. So I should get approved, right? No, you know what I'm saying? No, which is why you need your credit repaired. Now, at the same time, I'm not a mortgage lender. This is why we have this weekly segment. I don't know what is acceptable or unacceptable for the most part. Like, I know to delete negative items for you guys, but a credit report doesn't need to be perfect to purchase a home. I've learned that. Sean has taught me that. Um, a credit score, you don't need to 850. You can. It's always good. The higher, the better. But it does not have to be picture perfect. Is the point. A lot of people, they assume that because they saved enough money that all they got to do, they can almost like pay their way. Okay, Sean's up. Okay, cool. We see it. We
Okay.
see it. No, it's good.
Okay. Good. 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 All right.
I'm gonna
So
let Sean take it from here. We'll pick up later.
okay, perfect. So what she was saying was, yes, you don't need necessarily to have that perfect score to get, an approval. Uh, it's more about the score is important for the investors, right? But it's also important to have the bread and butter, the meat and potatoes of the report somewhat cleaned up. Okay, so when we look at a credit report, we know that there's different ways that someone could manipulate the credit report so that it shows, an acceptable score. Like you can dispute items, hide items, so forth and so on, right? Pay down credit cards, get the score up. But what's important is number one, what's occurred in your life, in your credit in the past 12 months. That's very important for most situations. So let me give you an example. So this is a credit report that I pulled for one of our customers, okay? And I've redacted their data for privacy purposes. So we can only see the balances, right? And payments and whatnot. So what I look for when I look at the credit report is a few different items. Number one, how new is this account? If I get an applicant that doesn't use credit too much, or they don't have much in the way of credit, or the credit's very young, I look at the date opened, right? And the date opened, okay, this is relatively new. It's 2 years for the most part, almost, right? And if I see someone that's maybe only has a couple of credit cards and they're 1 year old, they can be deemed a higher risk. So if someone has not a lot of credit or we call a thin credit profile, okay, and at the same time, they have a super high score. So they get on Credit Karma or Credit Sesame or Experian.com and say, oh, I got a 760 credit score. But I get their data and I can't get an approval through my automated underwrite because the credit profile is so thin. Okay. The age of credit can be very young. It's great that the scores are so high, but sometimes I may not be able to get an approval because the credit is so young, especially on your standard conventional financing. FHA, VA, not so much, but on conventional financing, it could be difficult to achieve an automated approval. Okay. Now, so if I look at this person's credit report, okay, what I've got here is a student loan, I think, basically, and a car loan. And I look at the payment history. So they were late here, okay, and here, right? These were all no lates. Okay, so I'm gonna scroll down to the derogatory section where it gets juicy. So all these are old closed account. I don't look at those for the most part. I'm gonna go down to the derogatory section of this. So let's move on down. All right, here's where the party starts, the derogatory accounts. Okay, so take a look at this. So once again, what I said was in the past 12 months, what has happened? What have we got in the past 12 months? Okay, as we can see, December 2023, we had a 60-day late. November, a 30-day late. This account was into collection status. Okay. Now, guys, on collection accounts, and I don't know if you look through on a regular consumer-facing report, Tamaya, I don't know if they, like on Credit Karma or Credit Sesame or Experian.com or whatever it may be, Identity IQ, I don't know how it reads on the source of the type of account. For example, for collection accounts.
It will say the same thing. It will say collection charge-off.
Okay, so there's two kind of collections that we kind of look at. There are medical collections, okay, and you have a regular non-medical collection. So a medical collection will say right on there, medical. And I think these guys have one. Yeah, see, medical. Now, for the most part, we're going to ignore this. We're going to ignore medical for the most part. Okay, we're going to ignore that. All right. Now, however, in the past, I've had loans decline. It's only happened to me once in my career. Someone had a lot of medical. We're talking about $100,000, and underwriting decided that, you know what, it could get to a point to whereas the hospital can come after the borrower for this past due medical debt and place a lien on the house that may supersede the mortgage lien. So they decline the loan. Now, once again, I rarely see somebody, with $100,000 in medical debt, but stranger things have happened. Okay. At any rate, so I can see here in the past 12 months, when I look at this is going to be a problem for my approval. So even if this person had a 680 credit score or a 620 credit score, right, this will be an issue. This will be an issue. A late payment in the past 12 months, okay, and it has the most effect on your credit score. As time progresses, and there's more time between when you pull the credit and the late payment, it's going to be easier on the credit score, okay? Now, when I see a collection account, and I know that it's non-medical, okay, because it doesn't say medical right here, it's non-medical, I'm going to take this dollar amount, the balance, right, balance right here, and multiply this by about 5%, and I'm going to use that for the debt ratio. Now, I'm not making you pay it off at closing, right? But I'm going to take this dollar amount times 5%, and that number will be tacked on to your debt to income ratio for monthly payments. So if you have collection accounts that are non-medical, it can adversely affect your purchasing power. So even if you had a sufficient credit score and I was able to get you approved, this collection would cost you in your purchase power. Okay, keep that in mind. So any non-medical collection account, so anything as far as credit cards you may have got when the collection, old light bills, old Sprint cell phone bills, whatever it may be, right? Any of those items that are in collection status that are non-medical can affect your purchasing power. Car repossessions. Now, when a car is repoed, it's a huge balance in most cases. Okay? And it's going to show up as either repossession or voluntary repossession or involuntary, right? And I count that the same as a collection account. So in other words, if you had a car repoed for, I don't know, $20,000 or $25,000, I'm going to take that $25,000, right, multiply it by about 5%, and now I got a payment of about $1,200 a month that's going to be tacked onto your debt to income ratio. Okay, so we definitely want to get those things rectified and cleared up prior to trying to buy a house, because it can, unless you have a higher income, that $1,200 a month can adversely or greatly affect your max purchase power. Okay. Now, when I see things like charge-offs we don't really care about though. Okay. If it's a charge-off account, I'm not going to put that into your debt ratio. So I'm not going to say this person had a charge-off of $3,400. I'm not going to multiply that by 5%. I'm not doing that. Okay. I'm leaving that alone. I'm leaving it alone. I'm not touching it. Okay. So I'll ignore it. Now, in most cases, a lot of companies immediately charge off the auto loan, but some creditors tend to place it as collection status. Okay, but that needs to definitely disappear. Okay, now as you can see, here's another charge off. This is a recent charge off. However, this has lates attached to it. Okay, so that's a no-no. Late payments. Okay, in the past 12 months. So basically, before it went to charge off status, they were late on it, and then of course you got the charge off status, right? And then if you move down, we have another collection. This is non-medical, non-medical, medical, non-medical, and I can tell by the name. Okay, non-medical, non-medical, non-medical. Okay. Now also let's look at paid collections. So this person has a paid collection with no balance, right? But it's not really doing much for him that he paid off that money. Look at that. I can still see the late payment. So this late pay still affect the score, right? Balance is 0, and it shows a derogatory comment, paid collection. So that's why you want to get to Maya.
I got a question for you. I'm sorry.
Go ahead.
Can I ask you a question about that? So, if I'm able to overturn the missed payments
Mm-hmm.
and it's still in collections and there's no balance, is that acceptable, or would the whole account need to be removed?
Ideally, it needs to totally disappear. Ideally,
Okay.
okay. However, once again, payment history is what's the number? 30% of your score, something like that. So if we cannot get it removed, then yes, we want those lates to disappear. That holds a lot of weight. Okay.
Mm-hmm.
Now look at all these little collection guys. These are a bunch of little collection guys, right? This holds a lot of weight in the scoring. And these were open around a certain time. This was open last year, right? 23, right? But if I look at these collection accounts, we can kind of tell when something went sideways in the person's life because all the dates will coincide with one another, right? Now remember, to recap, guys, we're not going to force you to pay off collection accounts or charge-offs for that matter. The collection accounts could adversely affect your score. So this is what I say when we look at credit profile, a tendency for derogatories or delinquent accounts. So once again, if someone tells you that, or you tell your loan officer that, I looked at Credit Karma or Identity IQ or whatever the case may be, or even myfico.com, and you have a certain score, right? That's all fine and dandy. That doesn't mean you're going to get approved with that score. What's on the profile definitely affects your approval and how the automated underwrite reads your risk level. Okay, so if we see that we're loaded with these collection accounts, especially if they occurred in the past 12 months, they don't like to see that. That's usually an automatic decline in most cases. Okay, and that's usually sometimes on FHA financing. VA is a little different. Okay, conventional, definitely no. So conventional, they may go back 24 to 36 months when it analyzes your credit profile. So if you're in a situation where you have to use conventional financing as opposed to FHA or as opposed to VA or USDA, right? And you have to do conventional financing, you really got to have a clean 24 to 36 month history if you have to go conventional. Okay. So all these things that occur in the past 12 months, 24, 36 months, it all would have to go. It would all have to go. Okay. But if you can get away with going FHA, really the past 12 months is kind of what they harp on. And sometimes the past 24 months also. But what's most important is the past 12 months of your payment history. So if I were to take this customer and refer to Tamaya, right? Let's talk about what I would focus on, what I would have Tamaya focus on. Okay. So what I would do, the first thing to recap, that I would have her focus on be the late payments or the payment history. Can I get those removed? Can I get those taken off? Right? Can I do that? Is that possible? Because this right here, it's so recent. It's what, 3 months ago, 4 months ago, right? It's definitely affecting our credit score and our approval. So can I get this whole thing removed? Because if I get this collection removed, this whole thing removed, the late pays goes away, score shoots up. Okay. Then I will look at what's occurred. What else has occurred in the past 12 months? This collection account, this charge off. This is older, right? In 21 was unopened. And then I have this opened in 20 and then 20, 23. So I'll take this off too, even though it's medical. It does affect the score. Okay. This one, December. And that's pretty much the gist of it. Okay. So I would have to Maya pinpoint certain items that I think will hold the greatest weight to get an approval for us. Okay. Now let's scroll back up to the top. What else we look at that holds a lot of weight? See this person, our credit card balances. Okay. When I do a soft pull credit report for you and I see, let's look at this account. This is a revolving account, so a credit card, right? The balance is this. Okay. The limit is this. So he's over our limits. Automatic, what is that? Sometimes 30, 40 points right there off top. You got to keep your credit cards nice and low, right? Right. That's an easy 30, 40 points right there in most cases. Then we have here, this other one is really close to the limit. And this one right here is close to the limit too. Okay. Very, very close, very, very close. So it's all close. So if we were to have this customer pay down these three credit cards, we could really see a jump in the score. Okay. So ideally, before you decide to go down the road of, qualifying for a home, we want to make sure our credit cards are paid down as much as possible and we don't use them as much. Okay. Those are one of the biggest things there that really beat us up. Now, if we look at their history, this person has a very extensive history when it comes to credit. So this column is the activity or the opened activity. Okay. So as you can see, we've got history going back to 18, 19, 2010, 2011. We've got 11, 11, 11, 11, 12, 13, right? 13, 13. So they have a deep credit profile. Now, a lot of these are student loans, right? And those don't hold much weight. But we do have credit history here. Remember, like I said earlier, if you're, let's use our younger crowd for a minute. Let's say Tamaya's 21 years old or 20 years old, okay? And let's say Tamaya worked in high school, graduated high school, and then got a job right out of high school. She's made her job for 2 years, okay, or sometimes even a year, okay? Now, if Tamaya, because technically you can't have a card in your name, solely in your name, not as an AU, solely in your name until you turn 18, right? Because you can't enter into a legal binding contract until you're 18 years old, right? Now, Tamaya gets a credit card at 18 years and 1 day, right? And her credit profile is clean as a whistle at this point. There's nothing on there. If Tamaya gets a credit card, she won't generate a score until 7 months later in most cases, 7 to 8 months later. Now, Tamaya could have mom or dad add her as an off user, when she was 13 or 14 for some cards, and she have an 800 credit score right out of the bat. But let's say she didn't have that privilege, right? So 7 months later, after she turns 18, she gets a credit card, and now her credit scores 720, 730, 740, okay? And also Tamaya has held a job at her place of employment since she got out of high school. Okay. Now, if Tamaya comes to me and says, I want to buy a house, they would probably decline her, even though her FICO 727, 3740, for lack of what we call trade lines. Okay. Tamaya only has one credit card. That's it. Okay. And at that point in time, I wouldn't have a 12-month history of her paying any other bills, like cell phone bills, car insurance, electricity, gas bill, water, trash, sewer, internet, right? Anything that's contractual, right? I wouldn't have that because she just turned 18 and just got on her own. Now, had she had bills in her name in high school, which I don't see how that's possible, maybe a different story, right? So what I'm hinting at, guys, what I'm talking about are people that don't use credit. They're ghost on credit, right? And they say, hey, I pay everything for cash. Cool. I don't trust credit cards. Cool. All right. But I'm not going to finance you, right? I'm not going to lend you $300,000 and you don't trust yourself with the credit card. Not happening. Okay. There is financing for that though, but it won't be as good as a time as if you were to have credit. Okay. So if you are the person that doesn't necessarily use credit or you don't like to, give it to somebody to learn how to use it effectively and responsibly. Okay. Because when you're trying to buy a house, once again, it's not only the score that we look at. We look at more items, look at the depth of the credit report. Okay. It's very, very, very important. All right. So, but you know what? I digress. There is a loan program that I can use in the event you don't use credit. Let's say Tamaya is about 25 years old. She's been around since she was 18, right? And Tamaya just said, you know what? I heard about credit cards. I heard about auto loans. I heard about installment loans or whatever the case may be. And I don't want any part of that. Okay, cool. So Tamaya, she has her own apartment at this point. She paid her for her car in cold hard cash. So she pays her light bill, she pays her internet, her cell phone, she pays her car insurance on her own, right? So everything in her life that she uses, and we're not talking credit-based obligations, she pays for it out of her checking account every single month. Cool. So Tamaya comes to me to buy a house. Like, Sean, I don't want to live in an apartment anymore. I'm tired of being there. I want to buy a house and I have money to put down. Okay, cool. No problem. Okay. I go to pull her credit report and there's absolutely nothing on there. She's a ghost. Well, I like to call them ghosts. She's a ghost, right? Now, I could still finance Tamaya. Okay. I don't need a credit score if I'm using FHA financing. So if you have a 0 score or non-applicable score, I can still get you financed if you have some bills in your name. I need about 3. I would get one of those bills. I'll do a 3-way call with each person. I would call Sprint, whatever you use. I would call the electric company, and I would call your insurance company. And I would say, hey, has Tamaya paid her bills on time for the past 12 months? And they'll say yay or nay. Hopefully they say yay, right? Hopefully they say yay, and she's paid her bills on time for the past 12 months. I now have established what we call non-traditional credit. Okay. So I can use that in lieu of her having a full-blown credit profile with the car payment, credit cards, and all that stuff we just talked about. Okay. Now remember, there's no in between. If somehow you have a credit score and it's low and bad, but there's no data on the credit report, I got to divert to that score. Okay. But if you have a 0 score or a ghost score, okay, I have to use other means to verify your credit worthiness, such as some of your bills. So hopefully a lot of us, and I've seen this a lot too, Tamaya, a lot of people have absolutely nothing in their names. They're living with somebody, living with a parent or a friend or whoever the case may be, and they have absolutely nothing in their name. No credit. They have a job, right? But they got their cell phone, their car insurance, electric, internet, lights. It's all in their mom's name or their dad's name,
Hmm.
right?
Yeah.
So um, please, whatever you do, in the event you are looking at buying a house in the near future, try to have some data, something in your name, so we can verify
I got another question, Sean.
you.
So, as you know, and some of you guys out there might know that I also sell trade lines. And if you guys don't know what trade lines are, just check out my YouTube because I've talked about it many times. I've broken it down. I've shown results before and after. But anyway, there was a young lady that I had. I had a whole family. It was a husband, it was a father and his two kids, and his daughter just turned 18, but him and I were preparing for her to turn 18. So as far as her credit was concerned, she had nothing on there, obviously. So she had a job. I was working there for a couple of years, but I put on a trade line. I put a major trade line on her credit card. I mean, on her credit report, and her credit naturally skyrocketed to, I think, 800, if I'm not mistaken. And then she had the job, and then I think he made her pay a cell phone bill, but that was it. Now, me putting them on a trade line, even if I put multiple trade lines on there, which sometimes multiple trade lines aren't needed, more than one isn't needed. It depends on the circumstances. Is that what can they do? And can they do that in replace of getting the three bills, or they'll still need that
They
because they're
still
AU?
they'll still need that. Yeah. So it'll give them a score, you know, all day long and twice on Sunday. They'll get a score, right?
Yeah.
But when an underwriter sees the authorized user accounts and it outnumbers her or his accounts, their
Mhm.
accounts, right? They're going to say they don't have anything in their name. That they disregard it because they don't count it in the debt ratio. They know they can't disregard it when it comes to the score, right? They can't. They're not going to say, hey, take this trade line off your credit report and then pull another credit report. They're not going to do that. But what they will do is say your authorized user accounts outweigh what you have in your name. So now we need non-traditional credit, the bills. But
Okay.
it does it does effectively get you the score that you need, which is sometimes 95% of the battle.
Understood. Understood. Okay, well, thank you for that. I think it was definitely needed. This topic was definitely needed because, like I said prior, my clients come to me. If they're not coming from you, then they find me online. They usually tell me, "Oh, I already know. I just need you to do X, Y, and Z,
Mm-hmm.
and I should be able to get a house." And because of I've sat through your courses before, um, your zooms before, and I've learned that, like, no, you need to get these items taken off
Right.
first or you just won't be approved. But people swear up and down, so it's best if I just say, okay, go to Sean and let him tell you and then come back. We do that often, as you know. So
Right. Exactly. And it always works out because once they kind of hear it from my side,
mhm.
it works out pretty good for them. Because what I have Tamaya do, I highlight and I pinpoint what I don't like about the file, and she
Mhm.
can laser focus on those as opposed to me telling the customer, "Hey, go get your credit fix and come back." That could take Tamaya a double time to get things done when I can have her focus on one or two items that I know is affecting our approval. It just laser accuracy is better than dropping an atomic bomb on credit, right? It's very
Mhm.
important. It's faster. So we want people to know that, if just call before you do anything on your own, especially when I see this a lot too. Tamai, this is funny because I think if I'm not mistaken, if you use Credit Karma or a lot of other softwares, you're able to dispute items right then and there online, right?
Mhm. Yep.
Okay. So they do the disputes. So I have a credit report full of disputes.
Mhm.
Now the rules are, if I'm doing FHA financing, the rules is that I can have disputes. Okay. However, they cannot be a total of $1,000 or over.
Oh. Okay. Okay.
Got to be
I didn't
below
know that. Mhm,
$1,000. Once I cross $1,000,
mhm,
then I have to. It's going to do what we call a manual downgrade. Okay.
mhm,
Then I
mhm,
do it. Then I do a manual underwrite, and I really dig into your loan. And I don't
okay.
want to do that, right? Because it gets
Mhm,
real sticky on the manual underwrite.
okay.
So therefore, if we have someone, because like I said, I was getting this a lot where people would I would say, hey, your score is not where these, or they would call me. They would say, hey, what credit score is required to do this certain program or to buy this kind of house or whatever the case may be. And I would say you need a 620 for that or 600. And they're like, okay, and I hang up and that's that. And they'll call me back in 15 days and say, hey, I'm at 620. Okay, cool. So I do another soft pull. They're at 620, but their reports are full of disputes. Because
Mhm,
those disputes, they're going to block that trade line that you're disputing from the
mhm,
scoring algorithm, right? So
okay.
underwriter can see that. But remember, like I said, sometimes you can be a little sneaky with it. You can get away with it if it's under $1,000 for the,
Mhm.
for the total balance. So sometimes it works, but you have to know what the balances are, so you can kind of ride that line properly.
Okay. Okay. Well, that's good to know. That's. I tell people you shouldn't dispute anything online anyway. It
Mm-hmm.
strips you of your rights if you decide to sue. And I recently have an attorney that were is a referral partner. I actually need to get another one, but you can't sue. You can't sue if they see that you disputed online. They can't touch you because you've literally stripped yourself of your own rights to defend yourself. Yeah, like it gets deep. So another reason, I've heard over time, like I've had clients that did do disputes through Credit Karma, not
Mm-hmm.
with the hack, because there's a hack I used to share with people, but just regular online disputes. And some people got deletions that way. It's very rare. The best thing to do is just to do pen and paper or give them a call. So
Got
yeah.
it.
Mm-hmm.
Okay.
Mm-hmm.
Makes
Okay.
sense. That does make sense. Yeah. So whenever I see that, I say, hey, you know what? You need to go talk to Maya about this and get this taken care of. Because I don't like giving um, credit advice myself. I kind of structure my words and what I say a certain way so I'm not put myself, make myself liable, right? So
Mm-hmm.
I don't want to. I don't mean to talk in code. I just know I can't say certain items, and I just kind of pass the buck, unfortunately, when it comes to things. But me and Tamayo know what needs to be done, so we tend to get it done.
Mm-hmm.
Right?
Mm-hmm.
Yeah.
Now we're now going into the second part of our usually 45-minute ish like um uh alive. So I wanted to share this with you. It's a reaction video. It's actually short, um but it's about mortgage in the crash of 2024. And I'm sure you get this often because I know I hear it a lot from clients. So I kind of want to share that with you and get your reaction and your thoughts. Is that cool?
Of course.
Okay, let me see if I can bring this to the screen. Okay, let me make sure I'm putting the right one up. Hold on for a second because I have like a billion screens. Okay, so this is we. Okay, I got it. Got y'all right here. And I don't know what to think about it half the time because this isn't my area expertise. Hold on, let me play it. Make sure I'm not on mute.
Turn to housing and another sign of just how sensitive buyers are to any movement in interest rates right now. Diana Olick has the very latest. Hi, Di.
Hey, Ty. Yeah, it's all in the weekly mortgage demand numbers. You see it there, and they're getting more and more sensitive to the small rate moves around bigger numbers like 7%. So, mortgage rates rose last week for the first time in 3 weeks, and as a result, demand came down for the first time since February. The average rate on the 30-year fixed rose to 6.97% from 6.84. That was last week's average from the Mortgage Bankers Association. But if you take a look at the daily rate, and that's from Mortgage News Daily, you see that by Thursday, the rate had crossed back over 7%, and it rose even higher to start this week. So, applications to refinance a home loan, which are most sensitive to weekly rate changes, fell 3% compared with the previous week, and were also 3% lower than a year ago. applications for a mortgage to buy a home fell 1% for the week and were 14% lower than the same week a year ago. And interesting on those purchase applications, with housing supply still so low and prices still so high, the average loan size for purchase applications increased to the highest level since May of 2022, Tyler.
What do you think about that? I'm sorry, hold on. Let me delete that. What are your thoughts? Is it affecting us? Is it affecting you?
I mean, it's somewhat. Well, okay. On an overall scale, yes. Right. Overall. However, people are still. How can I say not sound offensive?
People still need houses to live in.
Yes. People still need houses. That's true, right? Because things happen, right? All it's doing now is affecting the purchase power, right? Which does affect the home prices also. So when we have less demand for mortgage applications, not everybody has $300,000 in cash laying around to buy a home, right? So when rates kind of tick up a good bit, that also can affect home prices from what I've seen, right? Less demand, right? The more the seller of the property is willing to kind of weasel on down a little bit with that purchase price, which will affect the comparable sales in the neighborhood, which will say that, hey, these homes aren't selling for, as a round number, $300,000. They're actually going for $295,000, $290,000, right? So your neighbors had to sell their house to get it off the market, to get it sold for $290,000, $295,000, or $290,000 or $290,000, $285,000, and you're thinking your house is worth $300,000, but your house is worth two things. Okay, your house is worth what somebody will pay for it, right? Number one. Number two, your house is worth or can be valued based upon what your neighbor sold his house for, or a comparable sale, right? But it goes back to number one, your house is worth what somebody will pay for it, which goes back to the market rates. So if there's not a lot of buyers that can qualify for that purchase price because rates are higher, it's going to affect the prices of the homes. That's my opinion. I'm not an economist, but we see it every day, right? So as this drags out and as pent-up demand builds up, it's going to be an explosion. So when the rate cuts do happen in third quarter, maybe another one in third quarter, maybe fourth quarter, right? When those rates start to come on down, we're going to see pent-up demand, and there won't be, and we're not going to go because we're at about 7% on a conventional. I'm not saying best case scenario, right? FHAs are 6.5, 6.3, right? People still have the mindset of 2.875, 3.25%, 30-year fix. That's never going to come back. We're not getting.
I'm still stuck on the pandemic. I'm sorry. I'm still stuck on that. That interest rate was amazing. That you got me. Yes.
And that's a thing of the past now. Like, nobody can give you a 3.25 coupon rate. It's not happening. We're going to have to wrap our minds around, the low to mid fives, right? When the rate cuts happen, I think we may end up at, 4.5%, 5% maybe. When all the rate cuts through 2025 and 2026, if things keep going the way they're going, right, it's going to keep happening, right? It'll take a bit, right? So, but back to the demand. So remember, there's a lot of buyers on the sidelines right now, right? A lot of home builders are building homes. Okay, we can't keep up with demand. It's just not enough homes to go around. And I say that because in order for someone to buy a house, someone has to sell the house. Sellers aren't leaving their interest rates because their thoughts are, where am I going to go? If I sell my house now, I'm going to pay more for a house, for a new house to live. If I'm, in the same area generally, pay more for a house, right? And I'm going to have a higher interest rate, right? So sellers are like, I don't think I want to move. I don't think I really want to go there. Even though I need to, they're waiting it out. So now the buyers have nothing to buy. You see what I'm saying? Now, if and when the rates do come down 2025, 2026, or late 2024, oh, we go into the second quarter of next year, rates are coming down. Yeah, we'll start to see more movement, right? I think people will start to accept more that, hey, we're never going to see 3.25, 2.25 again. It ain't happening, right? But once we get down to maybe the low fives, high fours, and we kind of stay comfortable there for a minute, I think that we're going to see a push in home values. So we're going to see probably a little drop maybe as the next few months progress, possibly, right? We're going to have the natural seasons, right? Summer home buying season is almost here, right?
Mm-hmm. I'm looking forward to it. That's what I'm looking forward to.
Right. And then probably it's going to trickle down a little bit when most people get into schools, whatever, right? Because most people move around school time, right?
Mm-hmm.
So, people are saying, I'm hearing this a lot too. People are saying that we're going to probably see a dampening in prices. It's going to come down a little bit, right? Remember, I don't know, no idea, right? I'm just repeating what I hear on these internets, right? That's it, right?
On Beyonce's internet. That's what the
right, exactly. That's what they say on Beyonce's internet. So I do not know what prices are going to do, but people are expecting them to kind of come down, especially in combination with this NAR settlement, right? And we'll get to that some other time. But in combination with that and homes not being able to sell, it may depress prices slightly. It's a lot in the mix right now, right? But all in all, with what that guy was saying in the video, yes, these higher rates are putting a dampening on housing, okay? And a lot of people think that this administration wants to keep housing in check because in the event they drop these rates, right? What's going to happen? It's going to skyrocket home prices.
Right.
They want to keep them in check. That's what I think. Right. It's election year though, so
yeah. We don't know what we're going to be in for. Miss Lambert had a question. She said, I'm a first-time home buyer. Should I wait to purchase my first home until next year? Good question. I get that a lot too, Sean. Sometimes people come to me and I know they're not going to need to be with me very long. I don't need to fix a whole lot, but then they hear people get in their ear and, and they're like, what should I wait? What should I do? So I'm like, that's a question for Sean.
That's a good question. I get that a lot too. Should I wait or should I buy? I'm going to tell you to buy now, right? Because let's keep it a buck. That's how I get paid, right?
Yeah.
But I'm not going to sit and put you into a bad situation. The reality of it is, here's what I always say. Listen, if you can afford to buy now, if you can afford it, it's not going to break you, right? If it's not going to break you, yes, go ahead and buy. Okay. Now, here's the problem that I have with waiting, right? The problem that I have with waiting is that I think the writing's on the wall. We're going to see home prices shoot up. Okay. What a lot of first-time home buyers don't want to do is being in bidding wars. I pre-approved so many customers in 2021, 2022, 2020, and they never bought because they kept getting outbid, right? They kept getting outbid. And they couldn't, and a lot of them needed money for closing costs or some kind of seller concession. Meanwhile, there's some other cat coming down the street buying the house 20 grand over asking price, right? We asking first-time home buyers to put an extra $20,000 down to win the bid on the home because you're going to get outbid. You don't want to play that game. That is heartbreaking, depressing, and frustrating. Right now, average days on market can be sometimes 45 to 60 days in certain areas, which means that you're not getting the bidding wars with people in certain areas, certain parts of the country, right? You see what I'm saying? So to answer that question, if you can afford the payment that you would pay right now based upon today's interest rates, yes, I would buy because you can more than likely probably get a better deal as far as a decent purchase price reduction and or closing cost assistance from the seller, right? You're not getting, you're not having to buy a home as is. It's another thing. In the pandemic days, folks were buying homes as is. So enough to pass the inspection and appraisal, and they're buying straight trash sometimes just to say they bought a house, right? So now, right. So now, if you were to buy a house, now let's look at, for example, where we're at in Houston Metro. If you were to buy a house in Houston or shop for a home in Houston in certain areas, you know, homes that be in the market for a bit, right? You can go in the house and say, hey, I'll give you full asking price for a little less, but I want you to give me 10, 15 grand in closing cost concessions. And they'll probably take it. Okay. Then on top of that, once you get into the house and do the inspection while you're, you know, in your option period, right? You can probably get some more credits too to help with repairs around the house, right? In 2020, 2021, 22, you weren't doing that. Well, it wasn't that kind of party. It wasn't that kind of party. Look, this house is for 300 grand, take it or leave it. There's 10 more cats down the street trying to buy his house for 20 grand over. So what do you want to do, right? It's not a party anymore, right? So yes. So in the event you can afford to buy a home right now, based upon today's rates, I'll do it and then refinance the home later when rates are a bit lower.
And can I comment? I know I'm not a mortgage lender, but can I comment on that as well?
Of course.
So Christine, that was a great question. That's a real question. And I'm not in the real estate field or mortgage, whatever. I'm credit repair and all that. However, I have a lot of clients that come to me that they want a house, but they need their credit fixed. Let's say couples, for example, but they need to get out of their apartment, or they need to figure out, should I renew my lease or not, extended while you're fixing it, and then, you know, which is great. I always tell my clients, ultimately it's your decision. I'm not in the field. However, I can tell you what I'm hearing, what my clients are going through, what I'm seeing regularly, not necessarily what's on the news per se, what's the traffic that is coming to me and the conversations that I'm having, right? And I can show you the stats. I have thousands of people checking out my website on a daily basis. I get people and I take phone calls morning, evening, afternoon, all that. What I'm hearing is, since the pandemic, everybody and their mama, including myself, was just getting a house. Like Sean said, sometimes it's as is, low mortgage rates. After that, then what I'm hearing from my people and potential clients is that now they have to go rent, but the rent with the renters, what do you call it? The leasing agents, they're treating it like a house. Like you have to go through the same strict process. What's your credit score look like? Your credit profile. They don't care about a score. Before, if you applied for an apartment, they wanted to know your credit score and were you evicted, yes or no. Now they want to know your credit profile. What is your credit utilization like? Let's see your job info. Some places try to get a little spicy and they want to see your bank statement. And since when does an apartment complex or a leasing agent, when do they want to see that? They want to see that now. And as of today's date, a lot of people are saying that it's harder to get into an apartment than it is to get pre-approved for a house. And I have to say, I agree with that. And some people they're coming to me and I did a video where I broke down why people are getting rejected from rent reporters. I'm telling you how these agencies and these apartment complexes are looking at you beyond your credit report. They're looking in the past. It's not as simple to get an apartment, the apartment you want. Like, let's say if you're used to living a certain lifestyle and you want a nice, classy apartment, please believe it's going to be like Fort Knox to get in there. It is. It is easier to get a house, and I'm not just saying that, but it's much easier to get a house. I promise you. Okay, there's a lot of programs to keep in mind that will help you even after you get in the house. Like Sean said, you can refinance. And when Sean, when you were saying about buying a house as is, it made me think of the first house. So in case Christine, I don't know if you're new or not, but just check out my podcast. I tell my story. Sean and I have a history. I purchased my first home from Sean. And that first home was a townhouse, nice townhouse. But Sean, I don't think I ever told you about a couple months after living there. I mean, I might as well have bought the house as is, right? It was this guy, he lived there for 15 years, never paid an HOA fee, never fixed anything in the house ever. Prior to that, it was his parents' home. So he grew up in this home. Come to find it had like a weird smell to it, and we couldn't figure it out. Come to find out, it was black mold. Ripping
Woo,
and running, yeah, buddy. It's from
woo.
the kitchen into the living room,
Wow.
right? So they had to cut this out and do all that. It was crazy. It was bananas. Now, if I had the time, because I don't know if you recall, I needed to quickly leave the house that I was renting for 2,300 a month,
Hmm.
right? So I could buy. And it was kind of like if I had more time, I would have gotten the loan. I always was it the three? I call it. I always messed up the loan. Where the fixer upper loan,
The 203K
the
situation.
203. I would have loved to have that because um the score didn't need to be as high,
Mhm.
right? And like you said, most people are buying fixer uppers anyway. And when you think fixer upper, don't think like the shell of a home with no windows and no, it's not like that. You know what I'm
Right,
saying? Like it's
right.
not a shack, it's just a home that needs tender loving care. So I wish I would have went that route. Now this the next house, if I decide to purchase another house, please believe I'm buying getting a 203 k. But again, I don't want to tell you what to do or what not to do, but please understand these rental streets are not what they used to be. It's I promise you it's easier to get a home. Yes, you're talking about the interest rates and things like that,
Hmm.
but it's just imagine getting rejected by multiple apartments. It's like what? What? Apartment?
Right.
So that's something to think about. We have a couple more comments here. Let me see. So our guy MWD said, never wait. Nothing is coming down. Pricing LVL wise. I don't know what LVL means. You can reduce rate on the refinance. And then he said rate versus price. And then she said, Miss Lambert again, what do you think of rent to own, lease to purchase? Good question.
Mm. So it depends upon the situation you're getting into. Um, RTOs can be lease purchase options if it's done correctly and if it's done legally, it can work. But there's a lot of shady people out there, a lot of shady cats. So if you do anything like a rent to own or lease purchase, you want to use someone like Crescent Capital or you want to use Divvy, Home Partners of America, a reputable company, not just someone saying, hey, you can lease this with an option to purchase. Let me tell you why. You have to have a contract drawn up a certain way. The money that you pay, right, for your monthly payments, a certain amount of that, whatever you guys decide, has to be placed in an escrow account, a non-interest bearing escrow account. If it's placed in an escrow account, I can use those funds for down payment. Okay. So a lot of people do these lease options and they don't know what they're getting themselves into. So in other words, you can do a lease option, right? And then in 2 years, you can lose all your money that you put into it. A lot of folks, because I think you put a small chunk down on a lease option on rent to own, but it can be really tricky. You just got to make sure it's done correctly when it comes to the contract. And I'm not against it at all. Not against it at all, right? But yeah, it can be it can work out very well for you, or it could be an absolute nightmare as long as the contract is drawn up correctly. So RTOs or lease purchase options are not a bad idea for certain people, depending upon if you're just not ready yet, but you don't want to keep moving, right? You don't want to go rent an apartment and then go try to get into the house. It's much easier trying to buy the house that you're already living in. It's a lot less stressful.
Mm-hmm.
A lot less stressful, right? So yes, that RTOs are not a bad way to go as long as it's done correctly.
Excellent. And then she made the comment, I'm repairing my credit, and yes, some rental agencies have been asking me for all of my information. Yeah, it's just the game is different now. And I'm glad you're taking the initiative to fix your own credit. If you need any guidance, again, check. I have a whole DIY section on my website, my YouTube. I give you a lot of free game if you need some guidance with that. But even the credit game is also changing. Everything's changing, you guys. So there is not a solid answer for a lot of these questions like there used to be. It's literally, what is your best interest? It's like, finding someone you trust, like Sean and I, hearing us out and maybe saying, what options do I have if I go this route, if I go this route, in your opinion? It's just different. Everything is different now. I feel like we're being punished after the pandemic because it was just too good. You know what I'm saying? Like, it was just too sweet for everybody back then,
Right.
And
Yeah.
it just feels like that. So MWD landlord is risk adverse ASF LOL. So that's what he said. And then she said, yes, I'm new to your channel. Looking forward to going on your website and following. Excellent. And definitely look out for Sean. Sean and I, especially if you're trying to purchase a home, or thinking about it, definitely reach out to Sean. His information is in the description. You can click on his link, check out his website as well. And he's going to be here with us every Sunday. Okay. So you can ask more questions. All right. Now, Miss Denise, she said, is 203K better than FHA or home hacking? What's home hack? Can you educate us that don't know, like myself, what home hacking is?
Home hacking. Yeah. There's two different ways to home hack. But Denise, a 203K loan is an FHA. It's a subset of FHA. At any rate, home hacking is, someone buying their first house or a house as a multifamily home, right? So they live in one side and rent out the other, or they have a 3-unit property they buy. They live in one and rent two of them out, pays for the mortgage and gives them money to gamble on the side, right? If you have the patience now for a first-time home buyer, a 203K loan can be a little bit challenging, or it can be a little bit not challenging. What's the word I'm looking for here? It can try you. Okay, let's put it like that. There's a lot of moving parts in the 203K loan, right? A lot of moving parts, and if you don't have all your ducks in a row, it can be a nightmare. But it can come out very well. So if you want to use a 203K loan to renovate this 4-family property you saw down the street, and you want to live in one part, rent 3 out, that is an excellent idea. That is great. So if you find a home that fits the bill, so in other words, let's say Tamaya sees a 4-unit property, and let's say it's worth, and it's being occupied, but it hasn't been renovated for many years, right? It's not dilapidated, but it's just not up to snuff, right? Let's say Tamaya sees that. We can, of course, secure a 203K loan to rehab the 4-family property or 3-family property. Okay, you're going to put in the sweat equity. We're going to finance that money, and you'll be able to. You would have a stronger equity gap, right? Once the repairs are done, you can increase the rents, right? And now the property is cash flowing even more as opposed to when you first got it. So yes, Denise, to answer your question, if you can find a property to house hack that has the unrealized equity in it, so a room to make repairs, but you're buying it at a decent price, because what you don't want to do is, let's say a home is going to be worth $350,000 by the time you're done with it, and you're buying it for $300,000, but it requires $75K of work, right? So now you're about $25K upside down, basically. We don't want that. Does that make sense? We don't want that kind of problem. So you want to make sure the home that you are trying to rehab and buy, there's enough equity gap, or what do they say? Meat on the bone to make this happen, right? Because otherwise you'll end up in a bad situation. But yes, Denise, for all intents and purposes, yes, using a 203K rehab loan to house hack is a good idea. Using a standard FHA 203B loan is also a good idea too. Those are both good ideas.
Okay. And Ms. Lambert said that she wished that you and I were in Pennsylvania or Maryland. Funny you should mention that. Okay. I am a Philadelphia chick. I am born and raised in Philadelphia. I represent Philly everywhere I go. And I do help nationwide as far as credit is concerned. And Sean, you assist in Pennsylvania or Maryland or both?
In Maryland right now, yes. I'm working on my Pennsylvania licensing or pre-licensing education. So soon.
Excellent. So Christine, when you're ready, or like I said, just definitely reach out to Sean. I see that you said you're going to be here every Sunday. That's excellent. So definitely reach out. And if you need help with your credit, definitely reach out to me. And then for your mortgage, you got Sean right there. Okay. All right. Well, if there are, it says we have new comments. Okay. Yeah. Sean is a beast. Oh, you're from Philly. Look, Sean.
Oh, hey.
Yes, Philly all day. But I'm on the West Coast now. So yeah. And yeah, Sean is a beast. I tell all my clients that when they come to me directly and they are like, yeah, I need a good mortgage lender. I'm like, Sean's a beast. I got you. And then we have Sean. But yeah, you're welcome, you guys. What we're gonna do, we try not to go over an hour, but sometimes it just gets good, and I'm with it. Sean's with it, and we're always here to answer your questions. Also, if you guys would like to hear more any specific topics, let us know, like in the comments, whether it's credit, mortgage, both. It's more so mortgage related, and any credit topics, I just jump in there if needed. But if there's any questions, we usually hear the same stuff often, so sometimes we don't know what topic is more important than others. So just let us know, and even if we need to do a little bit of research on it, let us know. I actually did a podcast on that, on identity theft and credit repair. And I did a couple of lives where you actively saw someone using someone's identity at the dentist's office, and the police got her from the dental chair. Yeah, yeah. And she was using people's names and all that. Yep. And so yeah, definitely check that out. That's super important. Real quick, so I can actually tie that into you're getting your pre-approved for a mortgage. If you are when I fix your credit, or before I fix your credit, or even if I don't fix your credit and you're going to Sean, if you have identity theft on your credit report, you have to get it off so he can see your entire credit profile. And you have to make sure it's removed from all three credit bureaus, not just one or two, all three. So Sean can give you a good an actual pool or reading or of some sort. Now, fraud and freezing your credit report are two different things. So you can freeze your credit report, and I did do something like that as well. I did a video on that as well. It's a very simple to lift and freeze and lift and flip flop or whatever. It's very simple to do that. You'll still get good results, but when you do identity theft, it actually takes longer for you to get it off your credit report. So if you're trying to get a house, you need Sean to quickly pull your credit report and see where you're at, see if you're pre-qualified. Please believe it's going to take a little bit longer to get that identity theft off. Sometimes you got to write a letter, you got to call. Sometimes you call the bureaus, they act like they don't know who you are. You got to write them a letter. It gets messy. So just be careful of that. But remove the security freeze, yes, before you go to. Am I saying that correct, Sean?
Right.
Okay. Yeah. Remove that security freeze. security freeze, just lift it, let him run it. He's going to tell you when he's going to run it, and then you can put it right back on. Okay, it's just a little easier to deal with than a fraud alert. That's all. Yeah, that's all. And one more question for you, Sean. What is the best way to reach out, please, to Sean?
Oh, email me or call, either one, whatever is easy for you. Is my number in the bio?
It is.
Okay. Yeah. Email or call. Either one works just fine.
Okay.
Or text.
Well, you guys have a good one. Thank you so much. I want to wrap this up and just keep in touch with us. Reach out to Sean. And we'll see you next Sunday. I wish you guys the best. Okay, one more question. How long do I have to be employed for more? You need to contact Sean. You need to. No, trust me, Christine, I'm not brushing you off, but I'm telling you, Sean's good at what he does, and he loves helping. Okay, so definitely reach out to Sean. But do you want to take that, Sean?
Yeah. So, how long do I have to be employed? So, you technically a day or 2 pay periods, technically. So for a standard FHA mortgage, and I use FHA a lot, standard FHA, if you basically, here's the rules. Okay, we don't want to see a job gap more than 6 months. So let's say you started working in January, or let's say you hadn't worked in 3 or 4 years. You get a job in January. Okay, you can't buy a house until June or July, whatever the 6-month period is. Okay, if there is a more than a 6-month gap from your last job, you got to have 6 months on the new job. But if you get a job, if you had a job for a while and you changed jobs, okay, and there was not a 6-month gap, I can have you. I just need 30 days of pay stubs in most cases. That's it. So you don't have to be on the job for 2 years to buy a home. That's what a lot of people think is 2 solid years, but no. Technically, it's just 30 days of income. Awesome. Yes. So if you switch jobs to make more money, then that's fine too. Just got to show a month of pay stubs and probably an offer letter possibly, and I can use a new income as long as it's just your hourly base or salary. I couldn't use any overtime income or any bonuses on the new job. I can only use overtime or bonuses as long as you've been there for at least a calendar year. Once you're there for a year, then I can use OT, double overtime or double time, and bonuses, commissions, per diems, things like that.
Okay. Well, thank you guys again, and we're going to wrap up for sure this time. But Christine, seriously, definitely reach out to Sean, okay? Let him help you through it, walk you through the process if necessary. You're going to see more of Sean too pretty soon, so just look out for his stuff as well. But in the meantime, I wish you guys the best of luck on your credit journey. You guys have a good one. Sean?
Take care, guys. Thanks for tuning in.